Let's talk about Tesla. I mean, what a company, right? It's more than just cars. It's a story, a movement, a massive bet on what the future looks like. Everybody has an opinion on it. But today, we're going to try to settle that aside. We're putting Tesla on the rack, using a disciplined, no-nonsense framework to see what the numbers actually tell us.
Okay, so let's just start with the most important question you can ask about any investment. Is Tesla a great company or is it a great stock? Because, and this is crucial, those are two very different things. You can have a revolutionary company making world-changing products, but that doesn't automatically mean its stock is a good buy at any given price. Learning to separate the business itself from the stock price, well, that's probably the single most important discipline in investing, and that's the tension we're going to unpack today.
So how do you cut through all the noise and the hype that surrounds a company like Tesla? You need a process. You need a system. So in this explainer, we're going to walk through a report from Hauff Oilfield Services and see exactly how they apply their unique valuation method to Tesla. Just to be clear, this isn't a sales pitch. It's just an educational, totally transparent look at their analysis.
What's so fascinating about Tesla is this huge disconnect. On one hand, you have this narrative of just undeniable success. I mean, look at their record energy storage deployments, which is a huge part of their "we're more than a car company" story. But on the other hand, you look at the financial numbers and, well, they tell a much more complicated story.
So, how do we make sense of this puzzle? The tool used in this analysis is something called the Hauff Value Matrix, or HVM for short. The best way to think about it is like a diagnostic kit a master mechanic would use. It's designed to pop the hood, run a whole series of tests, and give a really clear, unemotional assessment of both the engine's health and its market price.
The whole goal of the HVM is to force discipline into the process. It systematically separates the analysis of the company, its financial health, how durable it is, from the analysis of the stock and what you have to pay for it. And that separation is absolutely crucial if you want to make a rational decision, especially with a company that generates so much passion and excitement.
The process itself is actually pretty straightforward. It's 3 steps. First, the company has to get through 4 non-negotiable checks they call hard gates. If it clears those, then we move on to calculate a durability score for the business itself and an asymmetry score for the investment opportunity. It's simple, structured, and you can repeat it over and over.
So how did Tesla do? Well, it passed all 4 gates. It passed solvency because it has a really strong liquidity cushion. It passed economic clarity because, we understand how it makes its money. Governance passed because its share dilution is low. And falsifiability passed because we can set clear, measurable conditions to test if the investment thesis is working or not. So the car is cleared for a much deeper inspection.
All right, now that Tesla's through the gates, we can really put it under the microscope. And we're going to start with its financial health. So what did the diagnostic find when we popped the hood? This number right here is fascinating. This is Tesla's net debt position, according to the report. And that little negative sign is the key. It means it's not in debt at all. It's actually in a net cash position of almost $16 billion. That is a fortress-like balance sheet. It's a huge sign of financial strength.
And this slide really drives that point home. A current ratio of over 2 means the company has more than double the short-term assets it needs to cover its short-term bills. So this is the business that looks incredibly well prepared to handle the usual ups and downs of the economy. So, is it a great company? Well, this health check looks really, really solid. But what about the stock?
And this is where the whole story just pivots. The report is blunt. After praising the balance sheet, the first negative point it makes is this one. Valuation is extreme. Right here is where that separation between the great company and the pricey stock becomes crystal clear. And here's the number behind that statement, 100.3. That's the company's enterprise value divided by its last 12 months of adjusted EBITDA. Now, EBITDA is just a fancy way of saying cash earnings before a bunch of accounting stuff is taken out. So this is a price multiple of over 100 times its cash earnings. Just let that sink in for a minute. And to really put that number into perspective, just look at this chart. On the left, you have Tesla, towering way up there at over 100 times EBITDA. And on the right, that little bar, that's the median for its automotive peers, which sits at around 11 times. The visual gap is just staggering. And this isn't just some abstract chart. Here are the actual numbers for the peer group. I mean, look at them. They're all trading in a very normal, pretty tight range. Tesla, at over 100x, is trading at nearly 9 times the price of its average competitor based on this exact same metric. The point here is crucial. The market is pricing in an absolutely heroic amount of future growth. So what exactly has to happen for Tesla to justify that price? And on the flip side, what are the risks?
The HVM framework forces us to weigh both sides of the coin. Let's dig in. Okay, on the left you've got the bull case. For today's price to make sense, profits need to grow dramatically to earn into it. The energy business has to become a real profit engine, and that promise of AI and autonomy needs to start showing up as actual dollars on the income statement. Now the risks on the right are just as clear. And the biggest one? The valuation multiple simply falls back to earth, even if the business itself keeps doing well. You add in pricing pressure and potential policy risks, and you've got a real tug-of-war here.
So after running all the diagnostics, passing the gates, checking the financial health, and weighing the valuation against the story, the Hauff Value Matrix gives us a final, actionable verdict.
And the verdict is watch. Not a buy, not a sell, a watch. Now, what exactly does watch mean in this system? It's really specific. It means a recommended position size of 0%. It's basically an acknowledgement that this is a good, durable business, and you can see that in its durability score of 3.52 out of 5. But the price is so high that the risk you're taking versus the potential reward just isn't favorable. That asymmetry score of 2.20 is just too low to justify an investment right now.
And this quote from the report's summary just captures the entire story in one sentence. The company's engine is running really well, but the sticker price on the window assumes it's going to win every single race for the next decade. And that is an expensive bet to make.
So the final and maybe the most useful question to ask is this: what could change the verdict from a watch to something more actionable? The HVM framework demands that we define this stuff up front before our emotions get involved.
And here are the triggers. These aren't just vague feelings. They are hard numbers. If Tesla's annual EBITDA grows from about $15 billion today to over $25 billion, that's a trigger. Or if that energy business keeps up its impressive growth and becomes more profitable, that's another trigger. This turns a really complex puzzle into a clear set of conditions you can just watch for. It's not about trying to predict the future. It's about being prepared to react to it when the facts change.